Welcome back to the Deep Dive. So today we have a massive market paradox to solve for you. How does the day start with, this incredible micro-euphoria NVIDIA, the AI king, just posts a blowout report, and yet it ends in total macro fragility. The Nasdaq just gets hammered, down 2.2%.
It's the central question, right? And it's not just a simple case of sell the news.
Yeah.
What we're looking at here is really a perfect storm. The way I see it, this whole reversal was driven by three very different things all colliding at once. You had a tiny flaw in the NVIDIA numbers, a huge macro shock coming out of Japan, and then a really fragile market structure here at home.
Okay, so let's start there. Let's start with NVIDIA, the stock everyone was glued to. I mean, a 62% year-over-year revenue surge, $57 billion. They raised guidance. Why on earth did that become a trigger to sell?
Well, that's the thing. On the surface, the numbers look, perfect. The adjusted EPS was a beat, $1.30 versus the $1.26 consensus. It was a classic beat and raise. Yeah. But for the big institutional money, the real story wasn't the revenue. It was the margin trajectory.
The margin.
Exactly. For the past year, the story has been crazy revenue growth and crazy margin expansion. But this time, the CFO's commentary basically signaled that the expansion party is over. Now it's just about preserving those margins, holding them in the mid-70s. And when a stock is priced for absolute perfection, like NVIDIA is, even just a slowdown in the rate of getting better is a huge signal.
So that's the excuse. The big funds found their technical reason to take profits on the chip king. But that alone doesn't explain a 2.2% rout across the board.
No, not even close. And this is where the story gets really wild, because while everyone in the U.S. was watching NVIDIA, the real earthquake was happening in Tokyo. Prime Minister Sanae Takichi announced this massive 17 trillion yen stimulus package. That's what, like $109 billion?
Wait a second. Japanese government spending causes the Nasdaq to plunge. I'm not following the connection there.
It's not intuitive, but here's how it works. The Japanese bond market just rejected it. They couldn't absorb all that new debt, so yields just exploded higher. The 30-year Japanese government bond yield hit an all-time high of 3.39%. For a market that's normally, incredibly stable, that is a seismic move.
Okay, and a move like that must have changed the math for global investors.
It completely collapsed the math. For years, the biggest trade in the world has been the yen carry trade. You borrow yen for basically 0%, and you buy higher-yielding stuff elsewhere, like U.S. stocks. Suddenly, you can get almost 3.4% at home in Japan with zero currency risk.
So the money comes home.
The money comes rushing home. We call it the Great Repatriation. Japanese institutions were forced to sell their foreign assets, like U.S. tech stocks, to bring that capital back. It was like someone pulled a giant liquidity plug from the global system.
And that takes us to the third shock. So this wave of selling from Japan hits a U.S. market that was already vulnerable.
Exactly. It was uniquely vulnerable that day. We got this delayed jobs report that was just very confusing. It showed 119,000 jobs added, which is okay, but the unemployment rate actually ticked up to 4.4%. So stagflation signal. Slowing growth, but sticky hiring. A powerful one. And that forced traders to price in a more hawkish Fed. But the real accelerant was the market structure itself. Liquidity was just gone.
What do you mean by that?
The E-mini S&P 500 depth, that's the book of orders waiting to be filled, it fell 60%. 60. To just $4 million.
Wow. And why does thin liquidity matter so much?
Because it means any sell order, even a small one, has a huge impact on price. It's like trying to drain a very shallow pool. The water level drops instantly. And then you add in the chaos of 0 DTE options, the zero-day options. As the market fell from the Japan selling, dealers who sold those options were forced to sell more and more stocks to hedge their own risk. It creates a feedback loop, what we call a gamma trap, that just spiraled the selling into a full-blown rout.
So when you put it all together for our listeners, it's a micro flaw in NVIDIA, a massive liquidity drain from Japan, and a domestic market that was basically a tinderbox.
That's it. This reversal wasn't some random panic. It was a rational, if painful, repricing event. I think it signals the end of that Goldilocks regime and the beginning of a new one defined by capital scarcity and competitive yields. At the end of the day, the structural selling from Japan and the broken market mechanics were just bigger forces than one company's earnings report.
A really powerful conclusion. So here's a final thought we want to leave you with to think about. If this yen carry trade is truly unwinding for good, then Prime Minister Takaichi's stimulus, the Takaichi put, is really a global call. It's a demand for capital to come back to Tokyo. What does a world where capital is flowing back to Japan actually mean for the sky-high valuations of U.S. tech stocks going forward?